A $500 million yacht never appears on its owner's balance sheet, and the law doesn't care. The standard story goes like this. Superyacht owners register their vessels in tax havens, shuffle ownership through shell companies, and sail away from scrutiny. It's simple, it's tidy, and it's completely insufficient. What we're about to see is far more intricate and far more legal than anyone admits. The real mechanism doesn't hide the yacht, it hides the owner. Start with the basics. A superyacht anything over 24 meters costs between $50 million and $500 million. Insurance alone runs $200,000 to $500,000 annually. Crew salaries, fuel, maintenance, docking, you're spending $1 million a month just to keep it floating. For a billionaire, that's pocket change. For a tax authority, it's visible wealth they can't ignore. So the received wisdom says, register it in the Cayman Islands, or Panama, or Malta. Flag it under a jurisdiction with no capital gains tax, no wealth tax, no questions. Ownership becomes a corporate veil. The actual person, the billionaire in Manhattan, never appears on paper. The boat is owned by Seabreeze Holdings Limited, incorporated in a building that houses 47,000 other companies. This explanation has one fatal flaw. It doesn't actually work. Not because it's illegal, it isn't, but because it's too obvious. Tax authorities worldwide aren't stupid. They've known about flag of convenience registries since the 1950s. Cayman Islands Incorporation is literally listed in every tax compliance manual. If that were the real loophole, it would have been closed decades ago. Here's what actually happens. The owner, let's call her the billionaire, doesn't own the yacht at all. Her trust owns it. Her trust is managed by a professional trustee in a jurisdiction like Delaware or Bermuda. That trustee is not her. That trustee has no connection to her on paper. The beneficial owner is legally obscured behind what's called a trust protector, a third party whose sole job is to exist. But that's still just paperwork. The real move comes at customs. When a superyacht crosses into international waters, which happens constantly, it becomes exempt from most national tax law. It's not in any country. It's not subject to wealth taxes because it has no fixed domicile. The crew files minimal paperwork. The yacht itself generates no taxable income. It's a depreciating asset owned by a trust, which means it's already written off as a loss. Now watch the incentives. The billionaire has a tax bill in her home country, but she's never resident on the yacht. Her lawyers ensure she visits fewer than 183 days a year. She doesn't work there. She doesn't conduct business there. By every technical definition, she's homeless. And homeless people, legally speaking, owe no local taxes on property they don't possess. The shell company layer comes next. The trust owns shares in a holding company. The holding company owns another holding company. The third company owns the yacht management firm. The management firm operates the vessel. At no point in this chain does any single document connect the billionaire to the boat. She's not the owner. She's not the manager. She's barely even the beneficiary. Technically, the trust is. Here's where it gets architectural. The yacht itself becomes a moving target. It docks in Monaco for 3 weeks, no problem, she wasn't there. It anchors off the Greek islands, crew only, no owner present. It makes port in Dubai, Singapore, Miami. Each jurisdiction has different residency rules, different tax triggers, different reporting requirements. The yacht is always somewhere else. The owner is always somewhere else. They never occupy the same legal space long enough for any authority to claim jurisdiction. The crew files what's called a flag state return. That's paperwork filed with the country whose flag the yacht flies, say Malta or Liberia. These jurisdictions have minimal reporting requirements and minimal enforcement. The crew reports operating expenses, fuel costs, maintenance. The yacht shows a loss. Losses can be carried forward indefinitely. On paper, the vessel never makes money. Therefore, it never owes taxes. But we're still looking at symptoms, not the disease. The real architecture is insurance. Superyachts carry hull insurance worth their full value. That policy is written to the trust. If the yacht is damaged, the trust receives the payout. The trust never reports the insurance proceeds as income. It's classified as return of capital, which isn't taxable. The billionaire receives nothing personally. The trust holds the money. The money compounds, tax-free, inside the trust structure. Now the loop closes. The billionaire uses the yacht rent-free. She's the beneficiary after all. She entertains clients on it, generates business relationships, makes deals. Those deals happen in international waters, so they're not subject to the same disclosure laws. She's not paying for the yacht, the trust is. She's not reporting the benefit as income. It's a trust distribution, which is taxed differently. She's using a $500 million asset, without it ever touching her personal tax return. The legal question is murky. Most countries don't tax the use of property you don't technically own. The IRS has tried to challenge these structures. They call it substance over form. but courts have repeatedly held that if the paperwork is clean, the substance doesn't matter. Nobody in this story is stupid. The lawyers are paid six figures to draft documents that survive audits. The trustees exist specifically because they are defensible. The enforcement gap is where the real vanishing happens. A superyacht can be in different jurisdictions every week. Does Malta care if the billionaire is using it? No, it's not her property. Does the US care? Only if she's a US citizen and spends more than 183 days there. Does the UK care? Only if she's domiciled there. She's domiciled nowhere. She's everywhere and nowhere simultaneously. She's a legal phantom. The implications ripple outward. A yacht isn't just a boat, it's a floating exemption from the tax code. It's a way to store wealth that appreciates without triggering capital gains. It's a way to enjoy luxury without reporting the benefit. It's a way to conduct business without the transparency requirements that apply on land. And because yachts are depreciating assets, they're also tax write-offs. The system is designed to reward movement and punish stillness. Some jurisdictions have tried to close this. The OECD's Common Reporting Standard requires banks to report wealth, but it doesn't cover yachts. The EU's Anti-Tax Avoidance Directive tries to pierce corporate veils, but it has exemptions for non-residents. Wealth taxes have been proposed in the US multiple times, none have passed. The gap persists because closing it would require coordinated global enforcement, and no country wants to lose its position as a haven. The Superyacht Vanishing Act isn't a secret. It's not hidden. It's written into law, codified by centuries of maritime tradition and modern tax code. Every element is defensible in court. Every step is documented. The magic isn't in the scheme, it's in the fact that the scheme is legal. The system didn't fail to close the loophole. The system created it intentionally, and then pretended to be surprised when people used it. This video is for educational and informational purposes only and is not financial advice. Always do your own research. Subscribe to explore the hidden incentive structures that shape wealth, power, and the rules that govern them. There's a new mechanism every week. Subscribe to explore the hidden incentive structures that shape wealth, power, and the rules that govern them. There's a new mechanism every week. This video is for educational and informational purposes only and is not financial advice. Always do your own research.